You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing Tesco, Associated British Foods, JD Sports, tobacco, Netflix, and there'll be a book review of the Snowball at the end. So John, should we kick off with Tesco?
Yeah, so Tesco's, they had their full year results out for 2020, with some of the highlights being that their full year sales were 53.4 billion, which was just over a 7% increase on the previous year. And if we break that down, it was up 7.7% in the UK, 14% in the Republic of Ireland, and fell 0.6% in the rest of Europe. But 91% of the total sales come from the UK and the Republic of Ireland. They did have significant increase in costs associated with COVID-19, including extra security staff, safety equipment, increased sick pay, and substantial losses at the Tesco's bank, leading to operating profits falling 28% to £1.8 billion. And the costs specifically associated with COVID-19 totaled £892 million. Reported operating profits across all of the retail businesses were 2 billion, which was down 14.8% at constant exchange rates, with a 13.7% decline in UK and Ireland and a 29% decline in Central Europe. A bit more detail on Tesco Bank, which reported an underlying loss of £175 million compared with a £193 million profit a year ago as the pandemic hit the lending activity and led to increased provisions for bad debts. And the bank is expected to return to profit this year, 2021, although the strength of the recovery will depend on the sort of wider economic factors. Full year capital expenditure rose 9.5% to 1 billion. That was largely down to increased maintenance spend on UK stores and investment in technology to support the online rollout. And of note, the capacity for the online shopping doubled in the past year. Free cash flow from the retail side of the business fell 29.8% year on year to 1.2 billion, reflecting lower profits, higher capital expenditure, and increased net expenditure on property purchases. And in terms of debt, it fell 1.9 billion to 13 billion in total. And that reflected a reduction in the pension deficit following the sale of the Thai and Malaysian business. And that also gave for a special dividend earlier in the year. And Tesco expects retail operating profit to recover to 2019-2020 levels this year. Full year dividend remaining unchanged at 9.15p per share. In terms of its valuation, it's listed on FTSE 100. Market cap is about 17 billion, and its current price to earnings 11.2, with a prospective yield of 4.7%.
That includes the sale of the Thai business, though, doesn't it?
That includes the sale of the Thai business.
I've had it about quite close to 19 without it.
So Sam, from these results, it would seem, obviously, we've got the sort of exceptional costs that are associated with COVID-19, but the recovery that's happened under Dave Lewis, and obviously he's left more recently, appears to be going very well. And it's focusing more on its core domestic UK business after years of trying to expand, in the States and Southeast Asia, some Central Europe, more unsuccessfully. And now it's back to its core operations. What do you think of Tesco's at the moment?
I like it. I think it's in our fantasy portfolio, isn't it? So
it is indeed.
We're obviously backing it, but I like it. I think you know what you're getting. It's a quality business, and that's not something I would have said 5 or 6 years ago about the business. But I think now, if you're buying it, you are buying into a quality business. That prospective dividend yield of 4.7% is very attractive, and a P ratio of close to 18-19. It's not cheap, but I guess if you want a quality business with interest rates as low as they are, you do have to pay up. The thing that I thought was interesting was that they said that they expect operating profits for this year to be similar to 1920. So basically it's just going to go back to normal. Did you have any thoughts on that, or does it not really matter because you're not buying it for growth, really?
I think it might. I know that's what they're guiding for, but I would expect actually after more people using it during the pandemic, and the stores have had a lot of upgrades. I think it's probably a pleasant place to shop. They're doing excellent deals with club card members. I would be surprised if it didn't grow a bit more actually, and that it didn't grow from the 2019, 2020. So I thought that was maybe a little bit more pessimistic than I would actually expect, but I don't know. I suppose one of the difficulties now is also that it's focused on the domestic market, but how much more can it grow within the domestic market? And is it now sort of at saturation point? I think its market share is in the high 20s.
Would you be bothered if it didn't grow though?
Because it's more of an income play. Probably not. I mean, it's not really a company that you'd be buying now looking for that sort of growth, I don't think. Maybe modest growth, but nothing more than that.
Well, I think as well, like if they were going to grow, like you say, they are pretty saturated in the UK, so it would be abroad. And they tried that.
And it's taken a long time to get back to where we are now. So you'd be very wary to try anything like that again, I think. I mean, do you think there are any other headwinds facing the business where there's sort of, someone like Amazon comes into grocery retail? They have sort of managed over the last few years to sort of weather the storm that Aldi and Lidl, the discounters, have brought.
That's what I was going to say, because I don't feel like if Amazon were to come in, I think if they've been able to see off Lidl and Aldi, I think they'd be fine. I guess the only thing is the Amazon delivery network is just so much better that if Amazon could compete in the delivery space and do it effectively, that could cause issues, but it's not something I'd be sat there. It wouldn't keep me up at night as a Tesco shareholder, I don't think.
Yeah.
Like, as well, I think, like we talked about when we covered Morrison's recently, like, I think it's not implausible that Amazon go out and buy Morrison's, but if they did, it's not Amazon are tough, but I wouldn't be sat there thinking, well, that's it, it's game over for Tesco. I think there's plenty of room for everyone.
Yeah, no, I would tend to agree with you there. So no, I mean, I own the stock and I'm happy to hold on to it. It's in the fancy portfolio. It's not the most sort of exciting or sexy stock, but I think it's, a pretty solid one to have there, generating nearly 5% and hopefully, growing the dividend over the next few years as well.
It says as well that the weekly delivery slots have doubled to 1.5 million a week. So I wonder if that's because the delivery is less profitable. I wonder if that's why they're guiding for profits in line with 1920. Because if they're expecting more orders, but like a larger proportion of them are going to be at lower margins, then that could be the reason.
You're right there. That could be. It's a difficult one. They are the dominant player in the online deliveries, but like you say, it's not the most definitely not the most profitable area of the business.
But the more they do, the better it is, because they'll get economies to scale, won't they?
That's right. I don't think no further thoughts on Tesco's really. Like it and own it, hold it. Yeah. If I wasn't a shareholder, I'd consider buying it at the current valuation, I think.
And probably check back in another 3 months to see how much we like it then as well.
Yeah, that's right. Okay, so next on the list, we've got another British retailer, Associated British Foods, which for anyone who doesn't know, I mean, what's the main part of the business, Sam?
Yeah, so Associated British Foods, so they're grouped into 5 different segments: sugar, agriculture, retail, grocery, and ingredients. On the grocery side, they've got brands such as Jordan's, Ryvita, Silver Spoon Sugar, Twinings. Sugar, they're just a sugar manufacturer. So the agriculture side of the business, that supplies technology-based products to farmers, feed and food manufacturers, processors and retailers. The ingredients business, well, that sells quite a lot of stuff that I don't really understand that well. So it does like enzymes and stuff like that. So, So AB Enzymes is an industrial biotech company specializing in enzymes and their applications in focus markets. And then they've got AB Mori, which operates globally in both yeast and bakery ingredient production. And then they've also got the retail business. And the retail business, that's basically just Primark. So they have come out with their 6-month results for the 24 weeks ending 27th of February 2021. So announced that group revenue fell 18% to 6.3 billion. And that reflects the closure of most of the Primark stores for over half that period. Revenue declines fell into a 46% reduction in underlying operating profit to 369 million. Both revenue and profit declines ignore the impact of exchange rates. The cash outflows from Primark closures were largely offset by ABF's food businesses, coupled with the successful reopening of some Primark stores. The group decided to repay 121 million received from job retention schemes, and they said the outlook outside the UK is mixed, and full-year retail profits are still expected to be somewhat lower than last year. So, for a breakdown by division, Primark revenue 2.2 billion was down 41% year over year. The group lost around 1.1 billion of sales because of store closures, and when stores were open, like-for-like sales were down 15%. Stores at retail parks performed better than city centre locations, and the UK saw stronger trading than Europe. No stores had to close in the US, and this region is now profitable. Overall, high fixed costs meant underlying operating profit fell 90% to £43 million. Reopened stores in the UK and Wales saw record sales in the first week of trading, with increased demand for traditional items like fashion lines. At the end of April, ABF expects 68% of its retail selling space to be open and thinks it will lose 700 million of sales in the second half, based on current reopening dates. A new Primark was opened in Chicago in March, and a further 8 across Europe and the UK are due to open in the second half. So that's actually quite interesting. So they've now taken Primark to the US. So I think they're now up to 12 stores in the US, which isn't much, but if they get a footprint in the US, then that could obviously be massive. For the grocery side of the business, that was buoyed by increased retail sales, which offset disruption to the food service. Revenue rose 8% to 1.8 billion, while underlying operating profit rose 6% to 199 million. Brands including Twinings and Ovaltine did well. Increased domestic demand and prices helped boost profits at the Ilovo plant, which is the sugar plant, which fed into underlying operating profits of 66 million, up from 12 million in 2020 in sugar. Performance was also helped by lower restructuring costs, cost savings, and a 1% increase in revenue to 763 million. Agriculture and ingredients saw revenues rise 8% and 2% respectively and delivered profits of 19 million and 78 million. These were both well ahead of last year, thanks to strong performance in China for agriculture and better margins in the ingredients business. ABF had net cash before lease-related debt of 705 million. It also had access to undrawn credit of 1.1 billion. There's a few things in the slides as well, actually. So the working capital's increased from 286 million to 947 million, which, well, not ideal. And the free cash flow after lease liability payments has changed from 141 million inflow to an 832 million outflow. And they've given a breakdown by segment. So in terms of return on capital employed, grocery business actually has almost 30%. And then the next best one is ingredients, 17%. Retail is only 1.5%, sugar's 8.7%, agriculture's 9.1%. In terms of the proportion of revenue, of the 6.3 billion revenue, 1.8 billion is grocery, 2.2 billion is retail, 763 million sugar, 746 million agriculture, and 735 million ingredients. But in terms of profit, agriculture is just barely contributing anything, really. So for the half-year results last year, agriculture profit was 16 million out of 683 million and 19 million out of 369 million. So it does make you wonder a bit why they're actually bothering with it. By geography, of the 6.3 billion of revenue, 2.186 billion was from the UK, 2.18 billion was from Europe and Africa, 801 million was from the Americas, and 1.14 billion was from Asia Pacific. And in terms of the valuation, the company's got a prospective dividend yield for the next 12 months of 1.7%. It's got a price to earnings ratio of 21.1, and that compares to a 10-year average of 20.3. And it's trading at a market cap of 18.16 billion. John, thoughts on Associated British Foods?
Well, I think the results were quite impressive in the circumstances. And I suppose it shows that even with Primark shut, the fact that it's got these different revenue streams actually can work quite well for it. And you mentioned some of the I know it's a small number of stores in the US, but performing well. So that's, there's some potential there for future growth. I'm not sure what to make of Primark. And what its future is, because I suppose it's got a very traditional model, Primark itself, rather than the rest of the business, in that it is all bricks and mortar retail, and how that's going to go long term. And I suppose other headwinds, whether there's increased focus on ESG and the sort of, I suppose, where the cheap clothes or cheap products that you do buy in Primark come from, and whether that has any impact further down the line. At the moment, it doesn't seem to. And, you saw last weekend the queues outside Primark's. So there's obviously a big demand. And I don't know, maybe for some of the online retailers, if they're selling such cheap products that cost, a couple of pounds, that Primark does, whether there's much profit in, shipping that to people. So I suppose Primark maybe has a bit of an advantage there, even though it's sort of the traditional bricks and mortar retail, which you'd expect to be more expensive. I don't know, but I think it looks like it's in pretty good shape considering. What do you think, Sam?
Yeah, I tend to agree. It's interesting what you said about Primark. I think we looked at spoons last week, and they are basically the spoons of retail, aren't they, really? They've gone for the lowest cost operator. And because of that, they've not attempted any transition to online, which probably makes a lot of sense. So they've got a website, but you can't order anything on it. I do like Associated British Foods. I like the diversification of the business. I like the fact that as Primark's gone down, the food business has done quite well. And although they're not doing as well as they would when all 5 segments are firing on all cylinders, but they've still been able to weather the storm. And I do just like the diversification of it. And I think it's a well-run business. It's so heavily exposed to retail that I don't like it, but I can see the value there. And I think a PE ratio of 21, I don't think it's outrageous.
No. Is it one that you'd be buying?
No. But that is because of the exposure to retail. I just wouldn't do it. I can't look at Primark and I don't know where it'll be in 10 years' time. I can't.
Yeah.
Whereas with compare it to I know Tesco is technically retail, but in 10 years' time, I struggle to see much of a difference. I'd expect them to be doing more delivery, but I don't think anything's fundamentally changing about the business model.
No, I would agree with you there. I suppose on the positives, whether it can expand in the US, but I suppose, the US, very competitive market, and there are similar offerings, I think, over there, but they're obviously not household names here. I know there are Target stores and they're, very popular. Not that I've done any sort of analysis further, but, who knows if Primark could even get a small, foothold over there, that could transform the business.
Yeah, well, we'll have to see, but yeah, I agree. If they can take it over to the US, I don't know what the US equivalents are, but if they can take it over and there's not really anyone else doing that way, it's just such a high degree of being the lowest cost operator, then they could potentially do quite well, but we'll have to see.
Yeah, no, we'll have to wait and see. Okay, so, we're retail heavy this week. We've got JD Sports next, so sports fashion technically. So it's the UK's leading sports and fashion retailer. They had their full year results out for 2020, and they announced that profit before tax and exceptional items was 433.5 million, and that was in comparison with 468.5 million the previous year. Included with the results, very positive performance from the Finish line, which is, and the JD business, but the Finish line in particular is a US retailer that JD own. And they say that they benefited significantly from the government stimulus over there in the first half of the year, driving a material but short-term impact on performance, with total revenues from those businesses, the US operations, increasing to 1.7 billion from 1.6 billion the previous year, and profit before tax and exceptional items increasing to 156.6 million compared with 94.2 million the previous year. The Shoe Palace business, which again is also in the US, had contributed a profit before tax and exceptional items of 13.9 million with revenues of 56.1 million. And the group commented that the overall gross margins increased within the sports fashion by 1% to 48.4%. And that compares favourably from the previous year of 47.4%. And that's largely due to stronger margin in the US, with strong demand resulting in lower levels of promotional activity in the overall market compared with previous years. After recognising exceptional items in the period, 76.9 million, principally relating to the impairment of intangible assets arising on the acquisition of the Foot Asylum business in previous years. Profit before tax in sports fashion was 356.6 million, and that compares with 427.9 million the previous year. And notwithstanding the temporary closure of the stores in a number of countries at various times of the year, total revenue for the group increased by approximately 1% in the year, 6,167.3 million, compared with the previous year, 6,110.8 million. Sorry, Sam, this will be a bit of a bugger to edit.
No, I had a look at the results myself, and they didn't make it easy for you.
No, okay. There's not as much coverage of them as well, so I was just going straight from the.
I actually found the result. One thing I didn't like about the results was like they have everything in black and yellow, and when you're trying to actually read them, the yellow is just distracting.
Yeah.
And they didn't have comparative, they didn't give you the percentages either.
No, they didn't.
I hate it when they do that.
Yeah, it's profit before tax and exceptional items decreased slightly to 421.3 million from 438.8 million the previous year. Shoe Palace contributed 30.9 million in the 6 weeks post-acquisition. They also have Go Outdoors that has brands like Millets and Blacks, dominantly in the UK, which they'd acquired. And overall gross margins within the outdoor business, the full year increased by 0.3% to 42.2%, in comparison with 41.9% the previous year. After recognising the exceptional items in the period, 20.4 million, principally relating to the restructure of the Go Outdoors business. In the first half of the year, the loss before tax in outdoor reduced to 26.5 million, compared with 73.2 million. Peter Cockwell, the chief executive, commented that after a difficult start to the year, with a further period of store closures in a number of our markets and the operational disruption from Brexit, it is pleasing to report that the stores of our domestic market have now started to reopen. We're absolutely confident that JD's premium multi-brand proposition retains its consumer appeal, and we look forward to welcoming customers back to our stores in our remaining markets in due course. We are encouraged with the trading to date in the new year, with the levels of sales retention in those markets which we have experienced closures running slightly ahead of those in spring 2020. Our recent completion of acquisitions of Shoe Palace and DTLR in the US, together with the conditional acquisition of Sizer in Central and Eastern Europe, are important steps in our evolution, which will transform our consumer connection in these markets and further develop our key brands relationships. And at this early stage, our current best estimate is that the group headline profit before tax for the full year to 29th of January 2022 will be in the range of 475 to 500 million. So Sam, in terms of this, another retailing offering, which I suppose is going for the premium end of the sports or sports fashion end of the market, what do you think of JT, partly as a brand and then in terms of the numbers and how it's performed over the last year?
I don't really like it. I think it's quite expensive. So it looks like it's a P of about 28, which is very expensive. One thing I worry about, I know they've acquired quite a few brands overseas, and I don't know those markets, so I can't comment on those brands, but certainly with the JD brand in the UK, and I imagine in Europe, I view JD as selling the higher end trainers. It's the Nikes and the Adidas. And what I think is the problem is that Nike, I don't follow Adidas as much, but I know that Nike are shifting to like a direct consumer model. So they're trying to sell them directly now online, and I think as they do that, they could just, at some point, they could start pulling the shoes from retailers like JD because they want everyone to go direct. And I think brands like Nike have the ability to do that. I don't think some of the other brands do. I don't think you're going to buy Slazenger shoes direct. I think it's more something you walk to the store.
Hold on, but buying Slash into Direct does mean going to Sports Direct because they are a Sports Direct brand.
Okay, but I mean, like some kind of like brand like that where it's like,
Yeah, I take your point.
yeah,
I take your point.
like
Yeah.
a Nike and an Adidas. You know, if you decide you want a Nike and Adidas, you'll go to Nike or Adidas. But there's some other brands where like, you don't walk in intending to purchase that brand, and so you will go into the store. So it just worries me that I think that this high end, well, it's high end trainers, isn't it? And if the highest end ones are taken away, what are they actually left with? And I think given the price as well, I wouldn't be comfortable with it.
Playing devil's advocate, do you think there's much in the JD brand itself, or do you think that's non-existent? Really, it's about nice brand, the brands that it sells.
It's a nice brand, but I think it's a nice brand in the sense that I associate it with high quality trainers.
Yeah,
and like if I need a new pair of trainers and I want some nice trainers that are going to last me a while, I go to JD. If I go to JD and Adidas and Nike aren't there, I can only speak for myself, but I don't think I would go to JD anymore. I think that would make a difference. In
terms of the sort of expansion in the US, and not knowing the market, but do you think presumably that's factored into the price, that it's, is on the more expensive side, but they're presumably expecting a bit of further growth over there, or hoping for it?
Yeah, I think it must be, but then it's the same problem, isn't it? I think I don't know the brands, but I don't know. I guess when you're left with like the lower quality brands, I find it too difficult. Yeah, so they bought Shoe Palace in December for $681 million, and they're on a $9 billion market cap. So it's a fairly sizable acquisition, but I mean, it's not like they're going over there with their own products and they're trying to grow it or anything. They're going over there and they're buying existing retailers, and it's at a time when like it's not an easy market to be in. So given the valuation and the concerns I'd have about the higher quality brands, I'd give it a wide berth probably.
Yeah, I'd probably echo those thoughts really. It wouldn't be one that I'd be looking at. I'd certainly be looking at Primark before I looked at JD. And
but part of it's the valuation though, because I think, if it was trading at a PE of 10, it's possibly a different conversation. But at 28, it's especially when that growth as well. You're pricing in a lot of growth, but all that growth, it's coming through acquisition. So it's not as high quality growth, in my opinion. You're having to go out and pay for it.
Yeah, that's that. Yeah, I mean, it's the shares. I suppose the share price or the shares themselves have performed quite well over the last 5 years, up 268% over 5 years. Over the last year, well, I suppose the last year today is not really.
The last 12 months, it's up 84%.
Yeah, it is. But I suppose I'd have to dig into it a bit more and just see how much its retail offering online actually. The results weren't the easiest to interpret, I must admit, looking at them, but how much was online and how much is sort of traditional bricks and mortar.
I wouldn't be keen to go back and have a look at them, to be honest. I don't think they made it easy enough, and I think...
Yeah.
Well, it's not the sort of business where I'm dying to go back and jump back into those results.
No, that's fair enough. But anyway, it's not one that I'd be looking at myself or for the fantasy portfolio at all.
No, agreed. Right. Should we talk about tobacco then?
Okay, so I suppose this is one of the things that happened, or one of the knocks to the FTSE that happened this week. So it was earlier in the week, there'd been talk from the US that the new US President Joe Biden had been looking at a policy to restrict or limit the amount of nicotine that would be in tobacco products, largely cigarettes, and would essentially limit that to non-addictive levels. And this hit British American Tobacco and Imperial Brands being the two big listed tobacco companies on the FTSE, and they were off about 7% on the day. It's been a bit of recovery since, but I mean, I suppose it was pretty seismic if something like that happened to those companies and essentially made their products, I suppose, non-addictive, and I suppose it would ultimately, presumably, destroy their cigarette business. I don't know, what did you think of the proposals, the likelihood of that happening and what it does for the future of those businesses, because I suppose those businesses on the FTSE, they're some of the biggest dividend players. I think British American Tobacco is number 2, which pays shareholders out about 5 billion a year. They've been at pretty low valuations for a good couple of years now. And, some commentators would be saying, can they get any cheaper? Well, they have this week. What would your thoughts on that be, Sam?
I mean, I'd say in terms of it's very difficult to say how likely it is to happen, but I would say if the president of the US wants it to happen, it's probably got a reasonable chance of happening, at least over there. If it were to happen over there, it'd be, for British American, it'd be quite bad. The clue's in the name, isn't it? But Imperial, they don't have as much of a presence in the US, so it wouldn't be as bad for them. I think the danger would be if other countries would start copying it. In terms of the idea itself, I think one of the things I really like about tobacco companies as an investment is they sell an addictive product, and that's fantastic. It's like when you do economics lessons and they talk about price inelasticity, and that's what they've got. They've been able to increase the price year after year, and people pay it because they're addicted to it. Ethics aside, from a business point of view, that is very, very attractive. And if you take it away so that if you take it to a non-addictive level, I think that makes a huge difference. I own Imperial Brands myself. I've not sold on this news. I don't plan to. If it were to happen in the US, that probably wouldn't concern me too much, because I just happen to own the one that's not got much of a presence there anyway. But if we start getting rumblings about it in the EU and in the UK, I'd probably run for the hills, because to me, I'd view it as pretty close to being a death blow, really. I don't see how you come back from that. What about you?
No, I mean, I suppose, from an investment point of view, you would have thought kill the business. And you commented on British American in comparison with Imperial Brands. So British American is a bigger player than, it's got a larger market cap than Imperial Brands, but it also has a much bigger US exposure. So in terms of its sales, in terms of its market share in the US, it's approximately between 35 and 36%, whereas Imperial Brands is under 10%. It's about between 9 and 10%. And then the sort of Ultra group, which includes Marlboro, that's closer to heading for the 50% mark. But I don't know, in terms of a policy, whether there'd have to be sort of an alternative, because certainly in the UK, when they talk about it, and one of the arguments that was made by some of the tobacco companies at the time of plain packaging, when they moved from having the branded packets to having those brownie green coloured packets, was that there'd be more room for counterfeit cigarettes. And then, not that sort of, obviously cigarettes are very bad for the health, but the government would get less revenue, which arguably could go towards sort of the health service, because it would be through sort of, illegal counterfeit cigarettes, rather than the taxes that you would get from the sales of legitimate cigarettes from these tobacco companies. So I suppose that's something that I don't know. I'm no sort of policy expert, but you would wonder about, because you'd still have a lot of people in the country who are addicted to the nicotine. So I'm not sure practically how that would work. And they don't seem to be looking to sort of harm reduction sort of methods, maybe, more of the vaping. That seems to be quite unpopular, but particularly in the US, I think, which has certainly hits the tobacco companies, which had invested heavily in those sort of not harm-free, but sort of less harmful products and alternative nicotine products. So I think it's certainly, it would be difficult, or it could be sort of game-changing for the companies if this were to happen. Given I suppose the market's reaction to it, it certainly hasn't been positive, but whether it's actually perceived to be that likely, you'd perhaps expect a bigger fall, but that's me just speculating. So, I mean, I have no idea how likely this would be. And I don't know whether it wasn't an attractive investment to start with for most people, and that's reflected in the share price. So you wonder how much worse it can get. And I suppose ultimately, if they still generate as much cash as they do, whether people, investors will still buy them.
I don't think it's moved much since we last talked about it, but I think Imperial Brand was at a PE of about 6 and British American was maybe about 8 or something like that.
Yeah.
Given the amount of cash they generate, I think they're very, very reasonably valued. But if they're not allowed to sell their products, that does tend to be harmful for a business.
Well, yeah. Or whether people would buy more cigarettes if you had to smoke 5 to get the same level of nicotine as smoking 1.
An elastic band around them.
Yeah. I honestly, I have no idea. But I mean, I suppose that was the biggest move I think we saw in the FTSE this week after, having a couple of weeks of gains. And I think the amount that was wiped off cumulatively was about 6 billion. But no, it's, I think it's one where they've always suffered from, or they're not always, but in the last few decades, they've suffered from lots of regulation. But this would be, I suppose, the ultimate regulation, really. And as an investment, I suppose it really depends on what you think of the ethics of the business and also the future, with sort of policy proposals like that.
Yeah, but I think at like a PE of 6 for Imperial Brands, you're just relying on it generating enough cash in the near term that the long term, it doesn't really matter.
This is true.
But if in the near term they're not allowed to sell addictive products, that would seriously impair that, wouldn't it?
That would. And sort of on that, I read a bit of an analysis that commented on, the menthol ban. And if you had the menthol ban, particularly British American, so when they acquired Reynolds a couple of years ago, they had Newport cigarettes, which were largely, I think they were referred to as, not by British American Tobacco, I'd point out, but as prison cigarettes. And they were sort of menthol, and menthol's thought to be, I believe, more addictive than the regular tobacco. And if they were trying to deter young people from starting smoking, a ban on menthol and essentially the Newport brand would be pretty terrible for British American as well. Probably less of a problem from Imperial if they're not so exposed to the menthol market.
All right. So should we move on to Netflix then?
We'll move on to Netflix. So US company of the week.
Yep. So it's actually a company that's actually from the US now. Last few weeks we've done
US listed companies.
It's been US listed, whereas we've got actual US now. So Netflix have come out with their Q1 results for 2021, and they added just under 4 million net new paid subscribers in the first quarter, which was lower than management's guidance of 6 million. Total number of paid subscribers is now 207.6 million globally, up 14% on last year. The group expects to add just 1 million net new paid subscriptions in the next quarter. There were improvements to average revenue per membership, and total revenue rose 24% to $7.2 billion. These figures will be in dollars. Together with some lower charges, operating income more than doubled to $2 billion, which was a record for the business. Netflix will also begin a $5 billion share buyback program in the current quarter. The shares fell 8.7% after hours following the announcement. So Netflix has said that the miss on subscription growth was because the higher number of subscriptions they added during the pandemic and the lighter content offering new content that they've had coming out because of the disruption to production schedules. They've said the retention of existing customers is in line with expectations, and they expect improved content offerings to be weighted towards the second half of the year. Interestingly, average revenue per membership rose in all areas. So they've increased it 9% in the US and Canada, 5% in Europe, 4% in Middle East and Africa, and 3% in Asia Pacific. The group spent $3.3 billion on new content for the quarter, flat compared with the same time last year. Higher revenue and lower content amortization costs meant operating margins were 27.4% compared to 16.6% in the previous year. And Netflix generated $692 million of free cash flow in the quarter, which was up significantly on the same time last year, which was only $162 million. And the group's on track to approximately break even in free cash flow terms this year. It is worth noting that that has been helped by the fact that the production's been disrupted, so they've got lower costs. And at the end of March, they had net debt of $7.2 billion, which was down from $8.1 billion at the end of 2020. In terms of valuation, no respective dividend, 12-month forward price to earnings ratio of 50.3, and that compares to a 10-year average of 133. and the market cap's $225 billion. John, thoughts on these results and Netflix as a company?
So I suppose it's positive that they've managed to generate a bit more cash, but the downside is the guidance is down in terms of new subscribers, and they've got a big competitor in Disney coming through. And I suppose with the reduction in filming as well, that would explain why some of the profits would be higher. But I don't know. I think I struggle a bit with the valuation, and I would worry about the competition for Netflix. So I probably wouldn't be looking at it much further at the moment. But that's just initial thoughts, really. What about you, Sam?
I mean, yeah, I appreciate that the cash flow has only really improved so much because they're not producing anything. There's no point being fooled by that. But a forward PE of 50, I don't think it's outrageous. Because I mean, as an example, like if they're going to go and add, like they're on about 207 million subscribers. I don't know where they can get in the long term, but let's say that they can add another 100 million. If they can add another 100 million, and they're projected to spend about, I think, 19 billion on content for this year. If they can add 100 million and do it whilst keeping that content spend at the same level, most of that is all going to flow through. So then it's like you're looking at it and you're saying, well, forward PE of 50, and you'd have to play around with the numbers. But could you say, well, I don't know, could they triple the profits from that level? And it's not unreasonable that they possibly could. And that's how you actually, I don't know, you quite easily get to a point where it actually becomes quite an attractive. I'd go as far as say, I know it's forward PE of 50, but if it's able to go and get those, say another 100 million subscribers, you can see how that valuation justifies itself. And it's not like a few years ago, where you were looking at it and it was so far in the future and it wasn't clear. The path to profitability is very, very clear now, and I think it's probably quite likely, because I know you've talked about Disney, but I think if you take out Disney, who else is there? Because I don't really. Yeah. The Amazon offering is not as good, and you get a load of stuff from Amazon, and I think I wouldn't really worry about that. I think I can't remember the figure, but HBO Max, they've added a tiny amount of subscribers in the last quarter, and that's when they've had like their movies going straight to it. So people obviously aren't these lower quality ones like HBO Max and Peacock and stuff like that. They're just not going to be able to match Netflix's library, I don't think, in terms of new content. If they're spending 19 billion a year, the only one that can really compete with that is Disney. And I think there's enough room for both of them. I don't know. I think it's actually, I think it's starting to look quite attractive actually to me.
So is it something that you might be considering or certainly adding to the watch list then?
I'd consider adding it to the watch list. It's something where, if I just think they have actually managed to create a moat for themselves, just in terms of the fact they're spending so much money on content now that, some of these other services that I know there's lots of services, but they can't compete with Netflix. The only one that can is Disney. And I don't think that's even because of content spend, because I wouldn't want Disney to go out and spend 19 billion on content. I'd rather they spent like 4 or 5 billion and just kept the content quality very high, because Disney's strength is their IP. So I think the valuation, I think now they're at a stage where the new subscribers are starting to just flow straight through to profit, which is where they've been trying to get to for years. I think, it's not going to 10x from here, but could it 2 or 3x? I don't think that's ridiculous. And if it doesn't, I think if it continues adding subscribers and profits at that level, I think that PE, it soon comes down.
Yeah. I mean, it's a convincing argument.
I wouldn't be buying it yet. I'd still want to. No. I guess it's in that strange phase, isn't it? Where it's almost like transitioning from like a growth stock to a value stock. And I appreciate it's still growing.
Yeah.
But,
yeah.
It reminds me of Microsoft a few years ago, to be honest. I'm not saying it's as good as Microsoft, but in terms of, I guess, in terms of like, it's like Microsoft, I know it is still growing at a silly rate, but like, you're not buying it for the growth anymore. You're buying it because it's such a great business and the valuation's fairly reasonable. Or you were a few years ago.
Yeah. Out of the companies this week, then, what would be your top choice?
So if we're including the tobacco companies as options, so we've got Tesco, Associated British Foods, JD Sports, Imperial Brands, British American Tobacco, and Netflix. That's a tough one, actually. It's not JD Sports. It's not going to be Associated British Foods, I don't think, as a Primark. I do like Tesco. I'd probably go with Tesco. I think it's
Tesco, yeah.
It's not cheap, but I think it's of the companies that I'd consider investable that are left. I mean, out of the two tobacco companies, I'd be picking Imperial before British American.
Okay.
It's incredibly cheap, but we've got the risks that we've talked about, which are risks that I didn't even think were there like 2 or 3 weeks ago.
Yeah.
Netflix, obviously, I've just explained why I do like it, but I think Tesco is probably the safest one on the list. And it's just a quality company. I'm guessing you're going to go with Tesco.
You guessed right. I'd go for Tesco's. And I suppose out of, Associated British Foods and JD, I'd probably go for Associated British Foods. But no, Tesco would be my pick of the week.
All we've got left is we've got a quick book review, and then that's it.
Okay, so what have we got?
We've got The Snowball by Alice Schroeder. Are you familiar with the book at all?
I haven't read it. It's on Buffett, is it?
Yeah, so it's basically like an official biography. So people were asking him to write a book for years, and it looks like he went to this journalist and basically told her he thought she'd do a better job than him. So she's written it, but then she's like talked to Buffett a lot, and there's his quotes in there on like his opinion. But it's interesting because she says at the start as well, like he said to her, like, whenever you hear, because he's obviously talked through his life with her, so she's got his version of events, and then she'll go out and find the actual evidence. And with anything, no one's got a perfect memory, so some of it will conflict. So she said at the start, he told her whenever she comes across 2 versions of events like that, to use the less flattering. So that was probably the true one. But yeah, it is really, really good, actually. So I'd actually read the book already about 4.5 years ago. So I reread it, and I'd forgotten how good it was. I thought it was really, really good. If it wasn't so dense, it'd possibly be the book I recommended to, like, if you had one book you could recommend to people about investing, it'd possibly be the one I'd pick, because I think all the key lessons are in there. The problem is, you need to know what you're looking for them to jump out. If that makes, I think if you were reading it for the first time, not knowing anything about investing, that stuff wouldn't necessarily jump out at you. So it's because it's not a pure investing book, but it is really interesting, especially at the start, because when he starts and he's using Graham's model, he's basically looking at what companies would be worth dead rather than alive. And then when he meets Munger, he switches to actually looking at what living businesses are worth and how they can compound. But I mean, it's very interesting, and he's obviously had a very interesting life, and just what he's been able to do is just unbelievable. So yes, I definitely recommend it. I think if you are into investing, I'd probably put it on like the must-read list. I'd say it's probably one of the top 5 investing books I've read. And it's interesting as well, because I read it 4.5 years ago. I don't think I didn't really have the knowledge that I've got now. And there's a lot of stuff in there that I definitely didn't appreciate, because I didn't come back to it expecting to enjoy it as much as I did. Yeah, I'd definitely recommend checking it out. It's about 800 pages though, so it's a chunky monkey. But if you're looking for a book to read in the sunshine, now that the weather's starting to get nice, then I recommend it.
Okay, brilliant. Well, thank you very much for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.